Hello, and welcome to Investing Wise Academy. I'm Jules, your host for this segment, which all about investments, stocks, cryptocurrency, and any other way you can earn. So if you're new to this channel, consider clicking the subscribe button so you will be notified when we upload informative videos. In this video, we will look at 4 different methods to earn passive income with cryptocurrency. I'll discuss the advantages and disadvantages of each of the 4 strategies and the potential earnings. DeFi and CeFi are both used in some of the methods. You can select the approach that best suits you. I'll go over how much you can make in percentage terms, and after that, you can look at your portfolio and figure out how much money you need to invest and how much more you can make in percentage terms. So without further ado, let's get started. Method number 1. Provide liquidity. The first method is providing liquidity, and this is on DeFi. Decentralized applications like lending protocols or DEXs will therefore need to be used. Once you know how to do it, it's not too difficult. By doing this, you can make between 2 or 9%. Now, this varies depending on the application and the blockchain. Unfortunately, setting it and forgetting is not an option. Farmers do need to sort of consider all the rates in effect and move their assets based on which platform is paying out. You'll need to look into a variety of liquidity incentive programs, but you can obtain rates of 2 to 9%. A person who provides their crypto assets to a platform to aid in the decentralization of trading is referred to as liquidity provider, also known as a market maker. In exchange, they receive fees from trades made on platform, which are regarded as a form of passive income. For instance, in PancakeSwap, which is essentially a decentralized exchange, tokens are exchanged by user. To exchange Binance coins for US dollar, one must pay a trading commission. Because you can supply your liquidity and your tokens, every centralized and decentralized exchange will levy daily trading fees. The passive income that you can generate comes from the trading commissions. It's not as simple as just putting it up there and earning the yield, so there are a lot of videos on YouTube that explains how to provide liquidity on pancakes, especially and some of things you should worry about and keep in mind when doing so. You can easily go on a PancakeSwap and find out the reward you're going to get for adding liquidity. It depends on token you're using, whether they risk assets or stable coins. Many people farm the incentive tokens from the DEXs and then reinvest them in the token pair they are using to augment the indexes. Therefore, depending on the token pair you use when providing liquidity on DEXs, you could take anywhere from 2 to 9 or even significantly more. Only stable coins I use it for. It's crucial to understand what an impermanent loss is before adding liquidity, because a high yield doesn't necessarily indicate that you're making a profit. When a token's price changes after being deposited in a liquidity pool, it results in an impermanent loss in the liquidity pool. If your token dollar's value is lower at the time of withdrawal than it was the time of deposit, this change is regarded as loss. Because DAI is a stable asset that can be traded for ETH, an ETH DAI liquidity pool has a lower risk of temporary loss than ETH SHUSI pairing. Since prices can always return to the initial exchange price in the future, the price change is referred to as an impermanent loss. If the price of your assets matches the price of the initial deposit, the temporary loss is eliminated. Only if you take money out of the liquidity pool does the loss become irreversible. Method number 2. Staking. Staking our cryptocurrency is the next way we can use it to generate passive income. Staking allows you to earn a 5 to 20% annually, similar to a savings account, depending on the quantity and kind of tokens you are staking. Now, since the stablecoin are in staking cryptocurrency, this has no relevance to stablecoins. Therefore, you cannot stake stablecoins inside of their safety. As we discussed in the first method, you must use them as liquidity. Staking, however, will undoubtedly result in a high return if your cryptocurrency is a proof of stake. You will undoubtedly receive more tokens if you stake during the bear market. If you believe that the future is promising, compounding your tokens at lower prices is preferable. A cryptocurrency can be staked in a variety of ways. Staking a cryptocurrency entails putting both the regular version and the staked version into a liquidity pool on a DEX, similar to the first method. This operates by essentially combining stake yields with user fees. However, Since they are essentially very similar assets with very similar prices, there is no long-term loss. Staking is a straightforward process whereby you can contribute stake a portion of your tokens to the growth of blockchain. In return, the blockchains give you a reward based on the number of tokens you have purchased. Staking is only possible on blockchains that use the proof-of-stake consensus mechanism. It is important to note, blockchain like Tezos, Cardano, Ethereum 2.0, Cosmos, and others are among these. So, a staking provider would be something like Lido. You can easily connect your wallet because it is decentralized. For Ethereum, Polygon, Polkadot, Solana, and other cryptocurrencies, they offer stakes. Matic is currently providing a bonus for a product they call Stake-Matic. It is extremely complicated in how it operates, but the basic idea is that you can now purchase a Matic coin that provides staking rewards without having to lock it up in the blockchain. As a result, if you stay Matic now, you could earn up to 92 APY or 147 APY if you put your money in a liquidity pool with USDC. With new platforms, I would always proceed with caution and stick to those that I know have been around for a while and can be trusted. By essentially farming for yield, you can make a lot of money. Method number 3. Use of lending apps. For beginners, using lending apps is the simplest option. Two most important ones are probably Celsius and Nexo. Depending on the cryptocurrency, they offer really good yields of between 2 and 10%. In the app, there are swapping feature as well. They also offer free cryptocurrency withdrawals. They are centralized, of course. Celsius pays about 7 to 9% for stable coins, and Nexo pays anywhere from 6 to 10%. How many platform tokens you own will determine the answer. You will not only receive the token you are depositing, plus up to 6% on Bitcoin and Ether. They offer very competitive rates. They are very basic. It's a centralized exchange, sort of a passive income app that offers all the features you would expect from an exchange. Many of these apps aren't accessible to Americans because you need to be a professional investor to use them, but they might be available in other nations. You know, they give you bonuses and they give you good rates for new investors. Celsius offers deposit of $25 if you deposit $100, and Celsius is $50 if you deposit $400. This is what many people choose, but you can check to see if their rates are competitive with what you're looking for. Method number 4. Arbitrage Bots. Spot future arbitrage is the next strategy to try and expand the market. Professionals carry out this task. This cannot be done by retail investor. Although it's too complicated, some trading bots can perform this. Finex is a good example. So, depending on the condition of the market, you could make between 7 and 12%. On the surface, they essentially buy on the spot market and sell on the futures market. You don't have any exposure to Bitcoin or Ethereum because it tries to print a yield of the market. Therefore, your goal is to simply convince them to remove the arbitrage from the market so that you can have a neutral exposure to the market. Therefore, you won't profit or lose money depending on the price of Ethereum or Bitcoin. Instead, you're trying to print a yield. On Pionex, they had this bot that, if you hold it for a long enough time, will yield an annual yield of about 10%. So that's a 10% yield on what you invest. So you can actually invest in US dollars, Tether, and stable coins, and you have a neutral exposure to the market, as I said, so you're not making or losing money on Ethereum, for example, going up or down in price, but over a year you may earn around 10 on your money. You are not profiting or losing money on price movements, rather you are printing a yield through the arbitrage that this bot performs. This yield may change depending on what people are doing in the futures market, and it is a little bit complex. Except for incredibly simple lending apps, many of the topics covered in this video may have left you with more questions than answers. You can comment with your questions. In summary, you can have between 5 and 7% of stable coins if all you want to do is provide liquidity on DEXs. The second method is to simply and quickly stake your cryptocurrency. You could get paid about 7% for that. Or you can raise that to, say, 20 if you want to employ the strategy of using liquid staking derivatives to effectively provide liquidity on DEXs. There is no doubt that lending apps are the easiest to use and pay 7 to 10%. Then arbitrage bots are quite simple because you only need to use one and you can get up to 10 of them depending on how complex your endeavor is and the yields you're after. And that's it for today. I hope you learned something new to make passive income with cryptocurrency. Please consider clicking the like and subscribe buttons below so you can keep up with me. Again, I'm Jules, and I'll see you in our next video here at Investing Wise Academy.